Hi, this is Lara at Elliott Wave Stock Market with your end of the week analysis for the trading week ending Friday 8th of July. Upward movement was not what was expected for Friday. I had a wave count prior which allowed for it to move up to but not above the all-time high, but I didn't publish that for you on Friday. I have a different variation of that idea today. The bottom line is, while price has not managed to make a new all-time high, the bear wave count is still preferred because the balance of evidence is still bearish from a classic technical analysis perspective. The bull wave count will not be seriously considered until price proves it to be correct. Price has to make a new all-time high before I will take that bull wave count seriously. I'm providing you with some targets for it at the end of this week only because price is so very close. In the event that we do see a new all-time high, I want us to have a roadmap for what should happen next. Those targets do not mean I take that wave count seriously, because I don't. And to tell you why, let's go to classic technical analysis first this week. Let's start with a weekly chart. The S&P has been range bound for several weeks, with the upper edge probably now needs to be pushed up about 2120 and the lower edge about 2040. We've got these overshoots. Last week it looked like we had a downward breakout, and it did come with a big volume spike, but price has more than reversed that downward move after the Brexit vote, and we've come up to be very, very close to all-time highs for the S&P. This did look like a classic downward breakout because it was supported by volume, but this does not look like a classic upward breakout. It is coming on weak volume. And so I do not think that this should be seen as an upward breakout because it's not supported by volume, and so it's highly suspicious. Within this strong upward week, we do have an increase in volume, but this week's volume total does include an options expiry date and a couple of very, very strong downward days. And so really, to see what the volume profile is doing for that week, you need to look inside at the daily chart bars for that one. Overall, though, we do still have a decline in volume from this week to this week. The current week just ended does have weaker volume than the prior week, even if we take out those downward days and the options expiry date. It's just not as steep a decline as shown by these weekly bars, and so price is moving higher, but it's coming on declining volume. For the bull wave count, that is actually quite a serious concern, because the bull wave count sees price moving up into a third wave that is not supported by volume, and third waves absolutely should be supported by volume. And so this volume profile with price rising on declining volume again is bearish. Overall, the volume profile, not consistently but more often than not, does tend to be bearish. Whereas here for these few weeks we saw, as price fell, volume rose, a bearish volume profile. Now at the end of this week we also have double negative divergence between rising price and lower peaks from on-balance volume. From this high here, price has made new highs here and here, but on balance volume has made lower highs, and that divergence, double divergence now at the weekly chart level, is bearish. There is no divergence at the weekly chart level between price and RSI. This previous point here corresponding to this high in price has made a new high, and RSI has made a very, very slight new high as well. RSI is a little bit weak, but there is no divergence to indicate weakness there at the weekly chart level. There is with on-balance volume though. Let's have a look at the daily chart, and let's make that a little bit bigger, actually a lot bigger. At the daily chart level also, it's pretty clear from this low, as price is rising, it's coming on overall declining volume. The rise in price is weak and not supported by volume. From this point here to this point here also, we can see divergence with on-balance volume at the daily chart level. Here are the corresponding points. We see divergence with price and RSI at the daily chart level, and so the upward movement not only is not supported by volume, it's also weak in strength. We've got divergence between stochastics and price, and there's double divergence here between MACD and price at the daily chart level as price is making new highs. And so this upward movement is weak in terms of volume and strength and momentum. It's not convincingly bullish. ADX is declining at the end of the week quite clearly. The positive and negative DX lines are whipsawing about each other. This is telling us the market is still consolidating, not yet trending. ATR overall at the end of the week mostly agrees. It's mostly flat at the end of the week. On balance volume continues to find resistance at this purple trend line. That's been tested 3 times now in the last few days, and so the strength of this line is slightly reinforced after it was weakened with this break and return here. This line is so far providing some resistance. It might continue to do so. If on balance volume does move above that line, we've got another line of resistance for it here. If on balance volume were to break below either of these yellow lines, that would be a fairly strong bearish signal. We haven't had that yet. We did have a break below this line previously, but then on balance volume just returned above that line. So this line is weakened, but the lower line's caught up to it now, so that doesn't really matter. Let's have a look at VIX at the monthly chart level. I had noticed some bearish divergence with VIX and price at the monthly chart level. It looks like it may have been resolved by those very 2 strong downward days after the Brexit vote of, I think, 23rd and 27th. 24th and 27th of June may have been enough to resolve that small multi-month divergence between price and VIX. At the monthly chart level, inverted VIX has made quite a substantial new high, and price has also made a slight new high from this month 3 months ago. So there's no bearish divergence between price and VIX at the monthly chart level, but the daily chart level there is. And this is inverted VIX. Remember, this is how stock charts do it. As inverted VIX rises, volatility declines. That's normal with rising price to see declining volatility. But here, price has made a new high beyond this prior swing high back on the 8th of June, and yet inverted VIX has not managed to make a corresponding new high. And so this tells us that the rise in price is not coming with an expected decline in volatility. Volatility is still quite bearish, so this is bearish divergence. The AD line from the all-time high for the S&P is showing a substantial increase in breadth. So this rise in price does come with an increase in breadth, but we've got some hidden bearish divergence here. This rise in price is coming with an increase in breadth, but the increase in breadth is substantially greater than it was back here, and so that tells us that this upward movement from price is weak. If you don't like to use the AD line as a measurement of breadth because it might be contentious, then how about the McClellan oscillator? This might be, for shorter term movements, a more reliable indicator of market breadth for the New York Stock Exchange. Here we've got the S&P making a new high beyond this prior swing high back here. This is at a daily chart level, but the McClellan oscillator has failed to make a corresponding high. That's telling us that this upward movement from price is lacking in breadth. Okay, let's go to the Elliott wave count now, starting with the bear wave count, because while price has not made a new all-time high, this will remain my primary and preferred wave count. Price has been boxed in. It's been range-bound for quite a long time, a substantially long time. Price will break out of this range eventually, and when it does, then we'll have a trending market again. But for now, price at the monthly chart level is range-bound. The Elliott wave count has a supercycle B wave most likely, but maybe also an X wave ending here, and still expecting a big supercycle C wave down. If we're in a new bear market, it's begun here with a leading expanding diagonal and now a very, very deep double zigzag correction. Primary 2 can move right up to, but not beyond, the start of primary 1. Only a new all-time high above 2134.71 would invalidate this wave count. That invalidation point is absolutely black and white. If this price point is breached by any amount at any time frame, then this bear wave count is fully and finally invalidated. I've got primary wave 2 at the end of this week, subdividing as a double zigzag. It resolves a couple of small problems. Let's have a look. Oh, before we get there, a word about leading diagonals. Subwaves 2 and 4 must be zigzags. Subwaves 1, 3 and 5 are most commonly zigzags, but they may also be impulses. This structure meets all the rules of a leading expanding diagonal, including the wavelengths. And this is why you see the third wave labelled ABC. It's a third wave within a leading diagonal. Those are the rules. Okay, let's have a look at this double zigzag for primary wave 2, where primary 1 ends down here, this point down here. So I've changed my labelling within this upward movement from a single zigzag, A, B, C, to a double zigzag. And now when we do that, we can count this little correction as well. My previous wave count, which saw it as a single zigzag, saw from this low to this high a completed 5-wave structure. So I was seeing it as a 1, 2, 3, 4, 5. Now that does also work and the subdivisions will fit at the hourly chart level, but I think this has a slightly better look. And now, importantly, from this low to this high, it makes sense. This looks like a 3-wave structure, and this wave count is counting it as a zigzag. The second zigzag in the double has moved price beyond the end of the first, not enormously and substantially, and in that case, it's a slightly unusual double zigzag, but it does still have mostly an upward slope, and this new high is somewhat reasonable beyond the end of the first zigzag in the double. The second zigzag subdivides A, B, C, 5, 3, 5. There's hardly any room left for price to move after Friday's session. It can't move at all above this invalidation point if the bear wave counts to remain valid. And so primary 2 should be over there if we are in a bear market. Primary 3 would reach 2.618, the length of primary 1, at 1281. That's the appropriate ratio for that target in this instance, because primary 2 is so very, very close to 100% the length of primary wave 1. Let's have a look at the hourly chart level, where X is this point down here, and here we have a zigzag 5, 3, 5. Now my problem at the hourly chart level, I've got two problems with this actually. I'm not convinced that my labelling of minor wave C is correct, so I'm leaving the invalidation point up here and allowing for just a little bit of sideways and ever so slightly upward movement possibly, or maybe a truncated fifth, to see a little fourth wave and then a very small little fifth wave to complete a more obvious 5-wave looking structure for minor wave C. That would be quite satisfying analytically. If it does, it would be a nerve-wracking end to primary wave 2 though, so let's hope it doesn't do that. If primary wave 2 is over here, then the very earliest indication we're going to get, which is fairly unreliable though, would be a break below the lower edge of this channel. This channel is not fully respected by this upward movement. It just doesn't fit very well into it. The S&P just doesn't always play nicely with trend lines and channels. We can have some confidence with a new low below 2074.02. That's the start of minor C, and I wouldn't want to put minor B anywhere lower than this. We could possibly put it up here, but it couldn't be any lower than this. A new low below this price point could not be a second wave correction within minor wave C, and so at that stage minor wave C would have to be over. At this high for Friday, we also have bearish divergence with price and MACD at the hourly chart level, further supporting the idea that this upward movement from price is weak in momentum. It lacks strength. At the weekly chart level, this is the bull wave count. If we are still in a bull market, then supercycle 5 is unfolding as a 5-wave structure, and it had to have a 4th wave sooner or later. Supercycle 2 was a zigzag lasting 3 months. Cycle wave 2 was a zigzag lasting 3 months. If cycle 4 is a flat correction over here, then it's lasted 9 months. The proportions are quite good, and when you look at the structure at the monthly chart level, it fits nicely within a trend channel. And so for this bull wave count, if this is cycle 4, it's very likely to be over here. But if it does continue further sideways as a double flat or combination, then it can't move into cycle wave 1 price territory. That's why the invalidation point is at 1370.58. If cycle 4 is over here, which would have better proportion, then cycle 5 may have begun. Cycle 5 is likely to be a 5-wave impulse. It could also be an ending diagonal, but an impulse is more likely, so let's assume the more likely structure. We could probably have primary 1 over here, primary 2 complete as a flat correction, and primary 3 beginning here. So overall, another probably 1 to 1.5 or 2 years of upward movement toward the target, and we'd have another 4th wave correction for primary 4 along the way. At 2,500, pretty much exactly, cycle wave 5 would reach equality in length with cycle wave 1. So that's the most likely ratio for a 5th wave. That's the most likely target. The big problem in terms of Elliott wave structure for this wave count is the structure of cycle wave 4. I have considered all of the 23 possible corrective structures, and this one has the best fit, but it has a really big problem. If we see this as a flat 335, B is over 90% the length of A. They both subdivide as 3, so that's okay. The problem is in primary wave C. It has to be a 5-wave structure. So we would see it as 1, 2, 3, 4, 5. The problem is in the 3rd wave. This 3rd wave may only subdivide as an impulse, but it looks pretty obvious like a 3-wave structure at the weekly chart level and at the daily chart level. For the bull wave count, cycle wave 5 begins here, and it has to unfold as a 5-wave structure. At this stage, it looks like it may be unfolding as a simple impulse. That's the more likely structure. We could have an impulse for primary 1, a regular flat complete here for primary 2, and primary 3 could have begun. But I'm going to leave the invalidation point down here to allow for the possibility that primary 2 might not be over here, only really because if it's over here, it's relatively shallow. But it is a nice proportion to primary wave 1 if we see it complete here. If it does continue as an expanded flat, it would be much greater in proportion than primary 1. That's also possible, and that might explain the lack of momentum and volume for upward movement. If this is a B wave, that would make more sense, but the proportion does still look right here. If it does continue further, then it can't move beyond the start of 1 below 1810.10, but it looks better to label it over here. The proportion's better, and so if primary 3 begins here, then at 2292, primary 3 would reach equality in length with primary 1. That's the ratio I'm using for this target for 2 reasons: because primary 2 is relatively shallow, and the second reason, this target fits so nicely with the higher probability target for cycle 5 at 2500. That has a high probability because a very common ratio for a 5th wave is equality in length with the first. Within primary 3, we may have intermediate waves 1 and 2 complete. I've chosen to label these at intermediate degree, although that's quite brief for intermediate degree waves, because a target for intermediate 3 fits so nicely with the next target for primary 3, which fits so nicely with the final target. If intermediate 1 and 2 are over here, then at 2263, intermediate 3 would reach 1.618, the length of intermediate 1. It would be an extended wave. But here's the problem quite obviously with this wave count. If we are in the early stages of a 3rd wave at intermediate degree within a 3rd wave at primary degree, price should be rising, showing a strong support from volume. It should be showing increased momentum and strength, and the fact is it's just not. but I want us to have a roadmap in case we do see a new all-time high. What would be the targets that could be expected from this bull wave count? Supplying these targets does not mean I have confidence in this wave count. I will only have confidence in it if price tells us it's correct with a new all-time high. That's all for me at the end of the week, and I hope that all of our members are having a fabulous weekend.